Okay, so welcome back to the desk. We're going to move on now to the next section of the video series, Having Discipline or Risk Management. In Having Discipline 1, Risk Management 1, we're going to be primarily looking at the principles behind risk management and why we have risk management in the first place. And it's very, very important to pick up these principles along the way. The first principle you're going to pick up is the principle that if we've been through the whole idea generation process, we've created our fundamental biases through the fundamental data towards currency pairs, and then we've been through the gatekeeping process and tried to time those fundamental ideas better, we now get to a point where we're about to take a position, or we've now started to take positions, and we're now actually looking to risk manage our trades and have an actionable trading plan. Now, the first principle we're going to pick up in risk management here is that you need to make an assumption in trading always. You need to make the assumption that there's nothing that you know that the market doesn't already know. That's very important. We're going to pick that up as we go through the basics of risk management and the principles underpinning as to why we have risk management. The next principle and underpinning that we need to understand is actually the psychology behind risk management. And really this is about understanding human psychology, and when understanding human psychology, being able to step outside yourself and being able to critically analyze weaknesses of humans from a psychological perspective, and then being able to seek to do the opposite. We're going to pick up that principle as we go through as well, and this underpins why we have stop losses and targets, which we've mentioned briefly in the video series prior to risk management, but now we're really going to start to understand how to construct trades and actually how to risk manage trades properly. We're also in this video going to go back to ATR, and we're going to start using the ATR assessment that we made earlier on in the video series, not only to assess opportunity, but also to assess risk. So we'll be going on the computer screen, and we're going to be using euro-dollar as an example. So we're now going to be dropping Aussie dollar, US dollar as our example, because we've used Aussie dollar, US dollar throughout the video series. We've got to the point where we have a fundamental predisposition or bias to be short Aussie dollar, US dollar exchange rate. We've been through the gatekeeping process and realized that our timing is off. So we're now going to sit back and wait for opportunities for Aussie dollar, US dollar to short into a rally. So that's served as a great example to this point. The assumption we're going to make here now is that you're actually running your watch list. You have a whole bunch of ideas on your watch list, and one of the ideas you want to pursue is short euro dollar. So now we're going to drop the Aussie dollar, US dollar as an example, and use euro dollar, US dollar as an example, as we've got to this point, it's on our watch list, and we actually want to go ahead and short it. So we're now deploying capital to this trade. So first of all, we're going to go through all of the basics of risk management in Risk Management Having Discipline 1, and then we're going to move on to more and further risk parameters in Risk Management Having Discipline 2, and actually look at an actionable trading plan for an overall portfolio later. And we'll be looking at further risk parameters that we can have in our portfolio to become a lot more of an efficient trader managing risk going forward. So let's go over to the computer screen and start looking at all of the reasons why we have risk management in the first place. That's a very crucial step to understand because longer term it means if you pick these things up, you'll respect risk management a lot more and have a lot more discipline than the average retail trader. And we'll also go and have a look at Eurodollar as an example of how we actually go about looking to construct a trade, deploying capital, and looking to manage the risk on that trade. And I'll see you at the end of the video for a recap. Okay, so now we're going to move on to the next section of the overall process. We're going to move on to having discipline and having risk management processes in place. So before we actually move on to an example of risk management application to currency trades, it's really important to understand why we have these risk management practices in the first place. Now, you have to understand that risk management practices are not an accident. You know, we don't apply risk management to our portfolios for no reason. They're not processes that people just dream out of thin air. They have a real rooting in psychology. And in order to really understand risk management, what we have to first really understand is trading psychology and getting our trading psychology sharp and correct. So, as a reminder, where does this fit into the overall process? Well, our main phase here was our idea generation phase. This is how we come up with trade ideas that are to come or to become potential trades, as in potential real positions. Then we have our gatekeeping process, which is our commitment of traders reports, technical analysis, and price action indicators to essentially cleanse our ideas and have a process to stop ourselves doing something stupid in terms of deploying capital to our ideas. Now, if we make the assumption here that we've generated a whole bunch of ideas that are to become potential trades, so a whole bunch of currency pair ideas and to go long or short the currency pairs, we've been through the gatekeeping process and we now think that everything lines up in terms of our fundamental idea plus our timing to get into the trade. We're now going to deploy capital and we're going to end up with a real position in our portfolio, in our retail trader accounts. So what we're going to look at here, first of all, is the having discipline section, where we'll be looking at trading psychology, why we have risk management principles or risk management practices in place within our trading accounts, and looking at how we actually apply it with some of the resources that we've had previously in the video series. So this will be having discipline 1, risk management 1. Then we're going to move on to applying some sensible, common sense risk management practices to our overall portfolio. And then later we'll be going on to working out our self-awareness statistics as traders. So in the overall process, this is where risk management or having discipline fits in. It comes in when we actually have deployed capital and we have real live positions. Now, in the PTM video series, we specifically looked at risk management examples in stocks. So how you manage the risk of a stock-only portfolio. And the underpinnings or foundations of why we use risk management are exactly the same in currencies. However, the application is just slightly different. So if you've already accomplished completing the PTM video series, as long as you fully understand those principles that we showed you in the PTM video series of trading psychology and why we have it, you'll have a very good idea of how to apply this in currencies anyway. but you may choose to skip this part or complete it in order to just refresh your memory. You know, there's no harm in going back and revisiting this area. In fact, you should always revisit this stuff as much as you can. If you've not completed the PTM video series, we'll provide you with the basic underpinnings of trading psychology and the principles as to why we have risk management in the first place. But in the PFTM video series, we're going to apply this only to currencies. If you want to understand the application of trading psychology for other asset classes, so stocks, sectors, so sector ETFs in the stock market, indices, and for real life examples on how trading psychology applies to all areas of your life, so career, business, relationships, family, etc. This is only covered in the PTM video series, and it's not going to be covered in the PFTM video series. So in the PTM video series, we'll give you a much wider application of risk management, but in the PFTM video series, we're going to be only concentrating on currencies, but having exactly the same principles underlying the theory behind trading psychology. And in the PTM video series, the overall application has improved a lot of guys' lives. So people who have come through the Institute, it's definitely strongly recommended if you can get yourself on the PTM course. If you're specifically only interested in learning the basics of trading psychology and applying that only to currencies, then the PFTM will cover that. But if you want to apply this to a much wider remit, then strongly recommended that you take the PTM video series as well. So let's get started on risk management. And there's a little secret that you need to know, which is there is nothing you know that the market doesn't already know. Now, that's a very strong statement to make. And it's one of the main reasons why we have risk management practices in the first place. So even if you've been through the whole idea generation phase and the gatekeeping process, and this all lines up and you're ready to take a position, this is an assumption that you need to make, and you need to manage risk and also the opportunity in order to make sure that you're not entering trades where your idea and the timing looks good, but you don't do anything if positions go wrong and positions even go right. Because there's no doubt about it, you're going to have volatility in your positions and your overall portfolio. Now, all the information that we've been through in the idea generation phase and also in the gatekeeping process, this is all actually publicly available information. We're obviously doing a hell of a lot more work than most people do, especially in the retail trader market. But you need to make this assumption. So let's go through it again. There is nothing you know that the market doesn't already know. You have to make this assumption because there's no way of you knowing that the market doesn't know it. So by making this assumption, it's necessary, therefore, to have sensible, common sense risk management parameters overlaid onto your portfolio, on all of your positions and your portfolio in its entirety, to ensure that you don't blow up or you don't consistently lose money. So this is one of the main reasons why we have risk management in the first place, is that if you go into a position where you've generated the idea as part of an overall large amount of ideas that are coming through your idea generation process, then you look to time these trades and everything seems to line up nicely, or the timing looks pretty good. It's always difficult to find ideas where everything lines up in perfect order, But if the timing looks pretty good from a common sense perspective, you can then still put a position on and potentially lose money because everybody in the market is now putting on the position or thinking of the same thing. So being slightly ahead of the game is what we always want to be. We always want to be looking forward. We always want to be increasing the odds in our favor by being smart, looking at the right things, doing more work in a lot less time, getting the right answers, predicting what's going to happen in the future, timing our trades as close to perfectly as possible. We're never going to be perfect. And then admit that we can still get it wrong, because there's nothing you know that the market doesn't already know. If you make this assumption, then you're going to have discipline. If you're wrong, you're going to look to manage risk correctly. If you're right, you're going to look to manage risk in that scenario correctly as well. And this is what we're going to move on to now. We're going to actually play a game. And this game highlights trading and human psychology very, very well and gives a lot of clarity as to why we even have risk management processes in the first place. So let's start this game and see how we get on. So what we're going to be doing is we're going to be trading marbles. So you'll see in front of you 2 boxes, and in this scenario you are getting paid. So what you're doing is you're actually trading marbles against me, and in this scenario you're getting paid. So if you win the game, I have to pay you. If you lose the game, you have to pay me. But in this scenario, you can only get paid. You're winning. So what you'll see in front of you is 2 boxes, box A and box B. In box A, there's 3 blue marbles and 1 red marble. So 4 marbles in total. In box B, there's 1 marble, and that marble is green. Now, you've got to put your hand in the box to pick the marble. You only get 1 shot in this game. So you're allowed to pick from either box and pick 1 marble. So if you put your hand in box A and you pull a blue marble, I have to pay you £1,000. If you put your hand in box A and pull a red marble, so the only red marble that's in the box, if you pull the red marble, I pay you nothing. If you put your hand in box B, if you choose to do that, well, there's only 1 marble there, so you'll have a feel around in the box and you'll pull out the green marble. If you pull out the green marble, so if you put your hand in box B, I have to pay you £700. So think about this for a moment. You only get 1 shot. Which box do you put your hand in? Box A or box B? I'll give you a minute to think about it. Box A or box B? If you put your hand in box A, you pull a blue marble, I pay you £1,000. If you pull the red marble, I pay you nothing. If you put your hand in box B, you obviously pull the green marble, I have to pay you £700. I'll give you another 20 seconds to decide. Okay, so have you made your decision? Have you put your hand in box A or have you put your hand in box B? Remember, I'm having to pay you in this scenario. Write it down on a piece of paper. Write down either box A or box B under the title Getting Paid on a piece of paper. So write down the box that you chose. So Getting Paid, and then underneath write A or B, box A or box B. Write down your choice on the paper. Okay, done that? Perfect. Now let's move on to the next scenario. In the next scenario, scenario 2, this is called paying out. So in the scenario, paying out, the roles are reversed in that you are now paying me. So you still have to put your hand inside one of the boxes, but now you are paying me. So if you put your hand in box A and you pull a blue marble, you have to pay me £1,000. If you put your hand in box A and you take out the red marble, you pay me nothing. If you choose to put your hand in box B, well, there's only one marble in there, the green marble. If you put your hand in box B, you will pull the green marble and you'll have to pay me £700. So paying out, you are paying me, but now you're still putting your hand in the box. So it's not me putting my hand in the box. You're still doing it and you're paying me. So you pull a blue in box A, you pay to me £1,000. If you pull a red from box A, you pay me nothing. If you put your hand in B, you have to pay me 700. Which box do you choose? Grab your pen and paper. I'll give you 30 seconds. Write down scenario 2, paying out, and then underneath the title, write box A or box B. I'll give you 30 seconds to make your decision from now. So blue marble, you pay me 1,000. Red marble, you pay me nothing. Green marble, you have to pay me 700. Okay, so hopefully by now you've got your answer to scenario 2, paying out. So we looked at two scenarios: getting paid, when you get paid, so I have to pay you, And the second scenario, paying out, where you still put your hand in the box, but the outcome is you're paying me. Let's go through the psychology of what we just did there. So in scenario one, have a look at your paper, have a look at what you wrote down. In scenario one, the outcome was you were getting paid. So we can classify this as you facing a positive outcome numerically. So you're winning the game, you're making money, you get paid. And when we look at the two boxes, what they can be described as in actually both scenarios, because the boxes stay the same, boxes A and B can be described as risk and certainty, respectively. So box A is risk and box B is certainty. And when human beings are faced with a positive outcome, human beings, in the majority of cases, will tend towards certainty. So in the scenario one, getting paid, usually 8 out of 10 respondents would actually tend towards box B, and 2 out of 10 would tend towards box A. So 80% of people will tend towards certainty, and 20% of people will tend towards risk. So 80% of people will choose to pull the green marble from box B because this provides certainty that they're going to get paid 700. Now in trading, this basically means taking profit too quickly. Human beings focus too much on locking in profits. And as traders, what we actually have to do is the opposite. We have to focus on letting our profits run. Now, how from this scenario, how from this situation are we making a profit? Well, if you look at the risk-adjusted payoff of each box, the payoff of box A is actually 0.75, 75% chance of pulling a blue marble, of which there was 3 out of 4 marbles, so 75% chance of pulling a blue marble and making £1,000. So the risk-adjusted payoff of box A is actually £750. So it's higher than box B by £50. So box A, risk-adjusted, is 0.75 multiplied by 1,000 equaling £750. The risk-adjusted return on box B is just 100% chance of making £700. Now, because the numbers are close together, it's not so obvious when you first look at it. But the principles apply. If there were bigger numbers involved, it would become more and more apparent. So if we take risk when getting paid, we make more than if we choose no risk when getting paid. And as stated in trading, this means taking profit too quickly. Human beings will always focus on locking in profits very quickly. So when you have a winning position in your portfolio, taking the profits, because now we think it's guaranteed to make money, so we lock it in quickly. And what we actually have to focus on is the opposite, because that in itself is actually just being human. There's nothing wrong with being human, but when it comes to trading, portfolio management and money management, we have to actually do the opposite. We have to suppress our urge to tend towards certainty. We have to focus on letting our profits run. So when we have a scenario where we're getting paid, we have to pull from box A, the metaphorical box. We have to pull from box A and keep our position and let it run. And to allow our profits to run, we have to just accept the risks and just accept that risk exists, and possibly even take more risk by adding more capital to the trade. So when times are good, on positions when we're making money, we actually have to seek out risk. We have to look to take more risk, or at least, as a minimum, run the position. So the outcome here, scenario 1, getting paid, when you do this publicly, when we take surveys on this with lots of people involved, especially in seminar rooms, when the Institute is presenting live, 80% of people in the scenario of getting paid, so facing a positive outcome, making money, will tend towards box B, and 20% towards box A. So if you wrote down box B, there's nothing wrong with that. It just means you're being human. But in trading and portfolio management, and in terms of risk management, you need to actually be doing the opposite. So in trading and portfolio management, it's actually wrong to look for certainty and pull from box B when you're getting paid, when you're winning, so facing a positive numerical outcome. Now, what happens when we move to our second scenario, when you are actually paying out? So when you were putting your hand in the box, choosing box A or box B, and the outcome was that you were paying me. Well, in this instance, you're facing a negative numerical outcome, because the outcome of this game, whichever box you put your hand in, you have to pay me. And if you recall, if you pulled a blue marble, you have to pay me £1,000 from box A. If you go in box A and pull a red marble, you pay me nothing. And if you put your hand in box B, you have to pay me £700. And if we think about this in the same way as we looked at it before, well, the boxes haven't changed. The risk-adjusted payoff of box A is 750, and the risk-adjusted payoff of box B is 700. And if you put your hand in box A, you're essentially taking risk. And if you put your hand in box B, it's certain. The outcome is you have to pay me 700. So have a look at your paper. Which box did you write down for the second scenario, paying out? So facing the negative outcome of paying me money. Well, when this is done over many cases, so when many participants in a room are asked to write down the answer to this question, we get the opposite of the scenario 1, getting paid. 80% of respondents tend towards or choose box A when facing the negative outcome, and 20% choose box B. And this is again being human. When faced with a negative outcome, human beings tend towards risk-seeking behavior. The vast majority of people will choose box A because there's a chance that they might have to pay me nothing or pay out nothing. But in the overall picture, the risk-adjusted payoff of box A is 750 and of box B 700. So the way to think about this is take a risk and pay me 750 or pay out 750, or pay out a certain amount with certainty. And in trading and portfolio management, in the scenario when you're paying out and facing the negative outcome, in trading, this means holding on to losing positions for too long. So instead of taking a guaranteed loss of £700, as in cutting the position, the natural reaction or instinct is to choose to hold on to the losing position or do nothing and hope that you get out the position for nothing. So we actually have to be doing the opposite again. In trading and portfolio management, what you have to be doing when you're faced with losses is take the guaranteed loss, not the unknown loss. Because if you think about this now, we've looked at this as a one-shot scenario in both scenarios of getting paid and paying out. But what if you did this exercise over an infinite amount of trades? Well, if you're getting paid, so you have winning positions, and every time you have a winning position, you pull from box B and you limit your upside on the winning position. And at the same time, when you have losing positions, so you're in the paying out scenario, you choose to pull from box A, then every time you have a winning position, you make 700, and every time you have a losing position, you're likely to be paying out 750. Well, it just means that over time and over an infinite amount of trades, you're never going to make money. In fact, the most likely outcome is you're going to be losing money. But if you do the opposite, so in the scenario where you're getting paid, you seek risk, and the likelihood is you're going to make 750. But when you're paying out, you guarantee that you only lose 700, then the likelihood is you're either going to, over an infinite amount of trades, break even or make money. So when times are bad, when we're paying out and losing money, we pull from box B, we restrict our losses. When we're winning, we pull from box A, we take risk and uncap the upside to our winning positions. We want to make sure we have as much upside as possible, if not infinite upside, on our winning positions, and overall with very little to no risk to the rest of our portfolio. So you can see now how human behavior in getting paid tends towards certainty, and when paying out tends towards risk. What we actually have to do as traders, portfolio managers, is take the opposite approach. And this is exactly why we have risk management parameters and principles in place in our retail trader books or even professional trader books. This is all very basic stuff for professional traders. This is exactly why they have strong risk management principles and parameters in place. Whereas retail traders don't really understand why risk management exists in the first place, and by not understanding it, they sometimes have risk management in place, but by not knowing what it really means behind it, become ill-disciplined and don't manage risk correctly. So this is very, very important to understand. And as mentioned previously, this type of analysis can be rolled out to many, many other genres across your entire life. So trading psychology in terms of improving your longer term risk management in your portfolio and improving your returns on your positions and overall in your portfolio can actually be applied right across your life. If you want to know all of that stuff, we go into great detail in the PTM video series. But here we'll be looking only at applying these principles to a currency portfolio. So how do we actually apply this to the Forex currencies market? Well, it's the same as if we applied this to the stock market, the same as if we apply this to commodities, or even the interest rate bond market. The principles all stay the same when trading any asset class in your approach to risk management. The first thing we have to do is always ensure that we use hard stop losses. So what do we mean by stop loss? It means if you go long or short an asset, you put a guaranteed limit order to trade out of the asset if it goes against you. So for example, if you bought an asset at 100 and you entered a limit order to sell your entire position, if the asset traded at 90 and then the asset trades at 90, you trade out automatically. This stops you from being human. What it does is guarantee your downside. So when that order is triggered, you're essentially pulling from box B. It's an insurance policy against you being human. So it guarantees your downside, pulling from box B, when you're paying out to the market. So when you're losing money, it's stopping you from being human and seeking out more risk when you're losing. So the human tendency would be to even buy more at 90 and try to average all the way down and keep losing money and more money as the asset continues to fall. And the same on shorts. If you short an asset at 100 and you enter a hard stop loss to guarantee your downside, where if the asset trades at 108, for example, you trade out automatically. You pull from box B. So when you're paying out to the market and losing money, it guarantees you what your loss is, so you know before you enter the trade what your maximum loss is going to be. So what your tolerance for a loss is, and it stops you from being human. It stops you from seeking out more risk and, for example, shorting more of the asset at 108, then shorting more of the asset at 115 and 120 and 130 and so on and so forth. The first cut is always the cheapest cut. Remember that quote. So entering hard stop loss orders to guarantee your downside, pulling from box B when you're paying out. What about targets? So what about when we're actually winning? Well, in trading and portfolio management, we approach this by using soft targets. What do we mean by soft targets? Well, if you purchase or go long an asset at 100, we don't want to limit our upside and say, for example, at 110, we will trade out automatically. What we want to do is have a target whereby we consider running or adding to our position when the asset gets to that price. So for example, if we go long an asset at 100, we may consider, if it trades at 120 or 130, because we're being paid, we may consider running the position or even adding to the position. So a soft target is a discipline whereby we may enter an order to buy a little bit more, and this order itself acts as a trigger or reminder to make us think about our real risk in this position. So we may enter a soft target of, say, 120 or 130, and if it actually trades there, so if we're disciplined enough or we're not too busy enough where we can actually know that it's traded there, then we don't have to obviously enter an order. We can enter a reminder into the system where it can basically ping us an email, or it depends on the brokerage platform that you use. You can get a notification on your retail brokerage platform that an asset has traded at a particular price, and then when it gets to our soft target, we consider our risk at that point in time. So what does a soft target do? It reminds us that we've got to a point where we're considering adding to the trade, or at least running it, and we're pulling from box A. So when we're getting paid by the market and making money, it's stopping us from being human. So we don't trade out automatically when we're making profits. We're actually considering the opposite. So how would this look, for example, specifically applied to the currency market? Well, let's use euro dollar, so euro USD as an example, and let's short some theoretically at 130. So if you sell euro dollar at 130 and decide a sensible stop loss is 133, and a good target, a good soft target, is 121, and then euro dollar then goes to 121 within, say, 7 weeks, which is a good time period for that type of volatility. Well, what's actually happened? Well, on paper, you have a mark-to-market profit of 9 big figures. So big points, not pips. And what you do in this situation, in a winning trade, is you must seek more risk, or at least run the position. However, in terms of risk management, the way you apply these principles is to roll your stop loss from 133 down to 124. So you protect your downside on the trade. So what you're doing is moving your stop loss from 133 to 124, because now euro dollar is trading at 121. And you're running the winning trade. But in this situation now, if you get stopped out, your profit is actually 6 big figures. So 130 minus 124. What happens then? Well, basically, if you move your stop loss from 133 down to 124, you've now locked in an almost guaranteed profit. Because if the currency pair, euro dollar, from 121 goes lower, you continue to make money. But if it trades back at 124, you make money anyway. So what you've got now is a free trade. You lock in the potential profit. Now you will have some gap risk, which we'll come onto in a second, but this is the principle you have to stick to. The gap risk is low, it still exists, but it's very unlikely that you're going to get stopped out on the trade above 124. So the other scenario that you might consider in this example is actually adding to your position. So let's say, for example, when euro dollar trades at 121, you double the size of your position, and that means by doubling the amount of notional exposure to the position, you've multiplied that by 2, so your average price on the short will be halfway between the 2 shorts that you've put on. So the short will be 1 spot 2550. That's going to be the average price that you're short at. So let's say, for example, you shorted 100,000 euro dollar, so one lot at 130. You put your stop loss in at 133, so you'll automatically trade out of that 100,000 if it trades at 133. So pulling from box B if it goes wrong and you're paying out and losing money. Trade out automatically at 133. You apply a soft target of 121. When it trades at 121, you sell another $100,000. So another one lot. And you double the size of your position. So you do that, your average price on 200,000 short is going to be 1 spot 2550. Now, if you roll your stop loss down at exactly the same time to 124, if you get stopped out, so if euro dollar goes from 121 to 120 to 124, therefore you getting stopped out, you're going to make 125.50 minus 124, so 1.55 big figures. So 1.5 big points, essentially. So what you actually have, because you have a free trade, is a situation where for every tick or pip or basis point, whatever your measurement is, for every point that it goes lower, you will make double the amount on euro dollar, but you're also guaranteeing that you will make some money on the trade. So you cannot lose. So this is why we pull from box A when we are getting paid, because we can use risk management parameters to actually enter a free trade situation. Now, we did mention there that you cannot lose. It's very unlikely that you will lose. You know, currency markets are open 6 days a week, but there is some sort of gap risk still there. The gap risk being that if the currency markets close on a Friday and reopen on a Sunday, you do have, depending on where you are in the world, Saturday or Sunday gap risk, where if a macroeconomic event or information comes out that is significant, your stop loss may not get triggered at 124. If euro dollar just goes up, so closes on Friday at 121 and then trades at 126 straight away on Sunday, your stop loss will be triggered if you leave it in the system at 126. So you need to understand that in the background there is still gap risk in currencies, even though market participants with conflict of interest will lead you to believe always that there isn't. There is still gap risk present when trading currencies. But hopefully you can understand the overall approach to risk management here when we're using hard stop losses and soft targets. So when we're using stop loss in the euro dollar example of 133, that's a hard stop loss. We're guaranteeing our downside. We're pulling from box B. If it trades at 133, we just trade out. We don't have to think about that too much. We don't waste our time on losses. But when we're winning, we have two choices. So when we're winning, we're pulling from box A because we are getting paid and making money. The first choice is to just run the position. But we roll our stop loss down using common sense. Our stop loss goes lower to a level which is still according to volatility over the time period that we look at, 1 to 3 months, our stop loss is still tight enough, which gives us discipline when trading out where the position goes against us, but still wide enough on our time frame of 1 to 3 months to give us a continued or good chance to continue to make money on the winning trade. If we get stopped out, we still make money. So this becomes a relatively low risk, free trade. Our second choice is to double the size of the position, or at least increase the size of the position, and stick to the principle that our new average price, so in this example where we're short euro dollar, our new average price is above our newly rolled stop loss, which means we're still guaranteeing ourselves that we'll make some money on the trade, but now we're getting paid double or at least more for every point the trade continues to go in our favor. Now, what would happen if we went long? So we did it the other way round. Well, we would ensure that if we're long, our average price is below our stop loss. So if the trade then went against us after we added to the position, we would get stopped out. But because our average price is lower than our stop loss, our automatic trade out would still ensure that we're making some money on the trade. But for every point euro dollar goes up, or the asset in general terms goes up, we're making double or at least some more on the winning trade. Now, there are further principles that we have to apply in our risk management of our trading book, one of which is seeking or using a 1 to 3 ratio on all trades. Now, in the previous example, it's not a coincidence that we selected a hard stop, so a hard stop loss of 3 points, so 3 big points in euro dollar, and a soft target of 9 big points in euro dollar. Now, when entering a trade and setting our hard stops and soft targets, we must always enter a situation in which our soft target is within the realms of reality and is realistic and possible within the time frame that we're looking at, so within the 1 to 3 month time horizon. And by the same token, our hard stop losses must be wide enough to give ourselves a chance of making money, but not wide enough that we're being ill-disciplined and allowing ourselves to be human. Now, setting a 1 to 3 ratio on all positions is a very good discipline. What we actually mean by that is whatever your stop loss is, and bear in mind it has to be within the realms of 1 to 3 month volatility. So we're being disciplined, we're not being ill-disciplined. So whatever your stop loss is, if you multiply this by 3, this should be roughly your soft target. So approximately your soft target should be 3 times greater than your stop loss. But the same principle applies in that your soft target should be within the realms of reality when looking at volatility within the 1 to 3 month time horizon. So let's have a look at this 1 to 3 ratio. On our previous example, we had euro dollar short at 130 and a 3 big point stop loss and a soft target of 9 points, so a soft target of 121. So our entry at 130, our hard stop loss at 133, and our soft target of 121. And that's not an accident, because when we look at euro dollar volatility, these look like sensible targets over, or sensible levels over, a 1 to 3 month time horizon. If we first look at the 1 to 3 ratio, the reasons why we do this is because it's simply good discipline, and there's 3 main reasons for doing it. So if we want to get paid at least 3 times what we pay out, then we're not going to enter trades that we look at and we decide that they don't provide us with at least this potential payoff. And that can only be a good thing. It means we're looking at volatility, we're looking at the realms of reality in terms of volatility, we're setting our stop losses at sensible, common sensical levels, and we're setting our soft targets at sensible levels, so within the realms of possibility on a 1 to 3 month volatility or time horizon, and our soft targets on a payoff of 3 times that of our stop losses. And we're saying if we don't see the possibility of making that on our targets, then we won't be looking at doing the trades at all. Secondly, if we trade out of all our losers at our stops and all of our winners at our targets, so not adding to the position or running to the position if it's winning, if we just trade out at our stops and we trade out at our targets, then on a risk-reward ratio, we only have to get 33% of our trades right. So if 2/3 of our trades go wrong and we get stopped out, but 1/3 of our trades go right and hits our targets, we break even. And this takes the pressure off us not requiring a very high win ratio to make money. So the percentage of the trades that you win on is your win ratio, and the percentage of your trades that you lose on is your loss ratio. And if we get more than 33% of our trades right when we're trading out at both our stop losses and our targets, we will be making money, which is obviously a good thing, which is our objective. And if we add to our winners, so the third reason as to why setting a 1 to 3 ratio on all positions is a good discipline, is if we add to our winners and then we get paid more, then we can get less than 33% right. So all round, adding a 1 to 3 ratio on all positions is a very good discipline. So we've picked up quite a lot of important principles there. Firstly, obviously picking up the box A, box B principles. So always pulling from box A when getting paid, and always pulling from box B when paying out, and therefore doing the opposite of human nature, in which people always look towards certainty when getting paid off, so looking towards pulling from box B when making money, and looking towards seeking risk when paying out. So when losing money, seeking more risk. We want to be doing the opposite of that. We want to be pulling from box A when getting paid and pulling from box B when paying out. And also picking up the principle here of entering trades that present at least 3 times more upside than potential downside. But how do we actually set our stop losses and targets on currency trades? Well, here we're going to use the Euro USD example as before. When we looked at the previous example, we used points, so big figures, as stop losses and as targets. This was deliberate and for illustrative purposes in order to simplify the concept for you, so you shortcut to its conclusion and understanding. What you'll recall is that in all of our volatility, so opportunities analysis, we measured everything in percentages or base metrics. And it's no different in risk management practices, because we're literally looking at the same data. What matters is the volatility over the time frame that we're looking at. And if you recall, opportunity and risk are literally the same thing. You just can't have one without the other. So we need to take a very common sense approach using our risk management principles. So we set percentage soft targets based on opportunity and hard stop losses based on risk. So we're now going to go back to the spreadsheet that we saw much earlier on in the video series, ATR rankings, and analyze ATR in order to set sensible stop losses and targets and stick to our risk management principles at the same time. So what we're essentially doing here is looking at a theoretical trade that's come through the overall idea generation process. The gatekeeping process has ticked many of the boxes, so our timing looks good, and now we're choosing to enter the trade, take a real position, and we have an overall trading opportunity and risk assessment in order to set our hard stop losses and soft targets. So we essentially have a plan when we're entering the trade, deploying capital, and this position becomes a real position in the portfolio. So if you go to the download section, we have an updated version of the ATR average true range rankings spreadsheet, where we have an example in there for euro dollar. So if you keep your ATR rankings spreadsheets for the tradable set always up to date, you'll be able to access the data and look at the historical volatility assessment, which is backwards looking, obviously, but you'll be able to use this to enable you to pick your stop losses and your targets very sensibly. So let's go over to the spreadsheet, ATR rankings. And if you recall, we had our entire tradable set with our daily, weekly, and monthly rolling ATR numbers, and we had them ranked. And you can see here that our monthly ATR on a 1 year rolling average for euro dollar is just under 3.3%. So if we use the example that we were using earlier, where euro dollar is at 130, and we're not applying a points system, we're applying a percentage system, then we're going to assess on our time frame 1 and 3 month volatility and look at our theoretical soft target and our theoretical stop. So we're going to be referencing the cell here, D25. Now, if we go to this cell here, F25, all we have to do is multiply across by 3 to get our 3 month volatility using our 1 month volatility. So we end up with 9.87%. And we can change this to percentage, and we can change this to 2 decimal places. and we have our 1 month volatility, which we know is around 3.3%. So we can change this to percentages. And all we have to do is take the euro dollar price and work out how many points for a theoretical soft target and theoretical stop loss are required as the parameters for this volatility calculation. So we take the 3 month volatility and multiply it by 1.3. So we have our theoretical soft target number of 12 points, or just under 13 points. Our theoretical stop is simply the 1 month volatility times 1.3, which gives us 4.2, or just under 4.3 points. So when we work out our soft target, we simply minus this number off if we're going short, and this presents us with our theoretical soft target, and we add this on to 1.3, and we get our theoretical stop loss. Now when we look at these two numbers here, what we need to do is remember our risk management principles. So when we look at stop losses first, our stop loss that we actually want to apply needs to be within the realms of possibility and be tight enough so that we're not being ill-disciplined, but wide enough to still give us a chance of making money. So going short euro dollar at 130, if we put a stop loss in by looking at these numbers, if we decided a sensible stop loss is 138, well, we're just kidding ourselves, because we know 1 month volatility is 3.3%, and from where euro dollar is trading, 134.28 means that in an average month, if it goes against us, it's going to go probably to around 134. So 138 is obviously being very ill-disciplined. If we're wrong for an entire month, then we're probably going to be wrong for a very long time. So probably wrong over our entire 3 month period. So we have to cut, and having a sensible stop loss is within the realms of possibility. So using the monthly volatility as a yardstick to measure what's possible and deploying some common sense. Now, if we did the opposite of being ill-disciplined and we wanted to be ultra-disciplined and said, well, why don't we have a stop of 131? Well, it just means we can be stopped out very, very quickly. And we're not really giving ourselves a sensible chance of making money in this scenario. So we're not looking at monthly volatility really. If we choose a 131 stop, we're looking at weekly or even daily volatility. So what we need to think about here is having a sensible stop loss around 1 month volatility. So around 133, 134 is probably sensible. And then we're looking to multiply that by 3 as a soft target. Now, if we go inside that number and multiply by 3, then our soft target is going to be higher than 117. Now we know that it's possible from our 3-month volatility analysis that euro dollar could quite easily within 3 months trade towards 117 or even trade at 117. So we have our soft target at either 3 times 3, 9 points, or 4 times 3, 12 points, and take this away from 130. So we're either going to have a soft target of 121 or a soft target of 118. And both of those soft targets are within the realms of possibility based on our volatility analysis. Now, one other thing that we could consider doing that we decided or looked at is a good potential strategy when entering trades from a risk management perspective earlier on in the video series is to look at taking a starter position. So what we could actually do here is put on a half size position rather than put on our full size position and widen the stop loss and widen the target and add to the position when it's actually working. So for example, if our full position size is 100,000 currency pairs, so one lot, and that's the limit that we put on ourselves when trading currencies in our portfolio, then this means we could short 50,000, so 5 mini lots in our portfolio, so 50,000 gross exposure to one position at 130. And if it trades lower to say 127, 128, we could then add to the position and then put the stop losses on from that point. But we could actually, when we put the starter position on, make the stop and the target twice as wide. So instead of having a 3-point stop loss, have a 6-point stop loss. And instead of having a 12-point target, have a 24-point target. However, we know when entering the trade, we're either going to cut it or add to it when it's winning. So we know that a 24-point target is very unrealistic, but we're not at our full position size. So we're in this scenario, we're either going to get stopped out on a starter position, or we're going to be adding to it when it just starts to work in our favor and deploy some common sense. So before we add the other 50% to the position and increase it to a full position size. And then when we do increase it to a full position size, we then look at our 1-month ATR and go through this exercise again and come to the conclusion of what our hard stop loss, our new hard stop loss is going to be, and our new soft target is going to be before we even add to the position and roll our stop loss. Now there's something to cover there as well. If you have a gross exposure limit on one position in a currency pair, which is 100,000 currency pairs or one lot, and the trade becomes what we call a winning trade because it's traded very close to or at your soft target, then when you have these exposure limits, because your trade and you're rolling your stop is becoming a free trade, because you're basically guaranteeing that even if you add to the position, you're going to make money. When you enter that situation, you are actually allowed to break your risk metrics because you basically cannot lose. So you get big and you run the position. When you're in a winning position, you have a lot more choices and your life becomes very easy. So when you're actually just running the position to a point before it gets to your soft target, you don't have a huge amount of choice until the trade is really proving to you that it's working and you're winning and doing really well on the trade. And then you've got enough room to maneuver, to add to the position and create a situation by rolling the stop loss where you have a free trade. So in this example with euro dollar, if you remember from earlier in the presentation, we shorted euro dollar at 130, and when euro dollar went to 121, we then added to the position by increasing or doubling the size of the position, and our average price became 125.50, and we rolled our stop loss to 124, thus ensuring that we would guarantee that we make money on the trade. So we'll make 1.5 points. We're making something, but we're also opening up the possibility that if euro dollar continues to go lower, we actually make double the amount of money for every point or tick or pip or basis point that it does go lower. So overall, in that example, what we're showing is that we've got guaranteed downside on the original trade where we have a stop loss. Our downside is absolutely guaranteed, and we're going to be pulling from box B and make sure our stop loss is triggered and we trade out of the position. If it goes in our favor and reaches our soft target, then we're looking to pull from box A, but sticking to the principle that we don't obviously trade out. We roll our stop loss, and when we roll our stop loss, it's below our new average price, which opens up the possibility of us making even more money, but at the same time guarantees that we trade out and pull from box B if we then begin to enter a situation where the trade is going against us. So as we build out the position, the risk becomes asymmetric. So we end up with a free trade. So overall, you can see how this works now on a 1 to 3 month time frame, rather than looking at very short-term time frames, coming up with poorly thought out ideas, only looking at things like technical analysis to generate ideas, not deploying a gatekeeping process that's overlaid to an idea generation process, which is fundamentally driven, and then timing is technically driven, and risk management is volatility dependent. You can see how this works now when we do it in a proper overall professional trading systematic process. Now, one other thing that you can consider doing after looking at the volatility assessment and deciding what your sensible stop losses and soft targets are going to be, then for example with soft targets, around your soft target, if there's key technical levels in the currency pair, then you can use those technical levels as well, where if they break those technical levels convincingly, then you can actually go in, and if it hasn't quite reached your soft target, or it's reached your soft target but hasn't broken the technical level, you can actually consider in the previous example of if it's not to reach your soft target, but it's broken the technical level, adding to the position. And if it's broken your soft target, adding to the position as well. Because now the market will be very focused on the fundamental drivers that have occurred that have made the currency pair break a big or important technical level. And as we were talking about earlier, don't worry too much about the small things, get the big things right when it comes to technicals. Everybody can make a claim that there's an important technical level every single day in every single asset, because you can find reasons to find technical levels. Get the big ones right. So get big support levels, get big resistance levels, get the big commonly formed patterns correct. And this is the approach that's going to make you, on the 1 to 3 month time horizon, with well thought out, fundamentally driven ideas, a solid gatekeeping process, and a solid volatility dependent risk management plan. This is the approach that's going to make you the big money, instead of sitting with a retail trading account that just dribbles out money and loses money every day. This is the approach overall that's going to make you the big money. And you've just got to stick at it and be patient. So that brings us to the end of having discipline, or risk management number 1. Let's go back over to the trading desk for a recap. Okay, so welcome back to the desk. What you just saw there is probably one of the most important things in trading, all of these risk management principles, because throughout an idea generation process, throughout a gatekeeping process, you can still always be in a position where you can lose money because you manage risk badly. Because trades can go wrong, trades can go right. More frequently, trades for retail traders will go wrong versus right, but the way you treat your losers and the way you treat your winners sets you apart as much from everybody else as to your idea generation process, your gatekeeping process, and all of that combined. Because you can still come up with great ideas, time them well, but manage your risk badly. So if you think about this in an overall process, risk management fits in to a point where we have fundamental ideas that increases the probability of us making money through the idea generation process, because we're concentrating on fundamentals and we're looking at the fundamental picture in the bigger picture, 1 to 3 months moving forward. We then fully admit to ourselves that an idea is just an idea and we can still mistime it. So we have a gatekeeping process which stops us doing stupid things. So the gatekeeping process is a layer that stops us getting into good ideas that are mistimed and we get stopped out, or bad ideas altogether. We then have another layer of risk management, which then basically stops us doing silly things as well when we have real positions with real money. And the underpinnings of understanding why we have risk management in the first place is really important to understand. Because if you don't understand this stuff, when you end up with real positions, you won't respect risk management. You will just keep thinking that you're right all the time, and you'll end up averaging into losers and losing a lot of money. So the most important thing to understand here is really that if you get to this point and you've been through the fundamental processes, you've got fundamental trade ideas, those ideas are just ideas, so we know we have to look to time them better. We then think that the timing is optimal and we're looking to deploy capital and we end up with a real position. You have to make the assumption still that there's nothing that you don't know that the market doesn't know. And you have to understand human psychology. If you don't, you won't respect risk management and you'll end up being one of these arrogant traders that ends up thinking they're always right, but you'll always lose money. So you have to be good at risk management as much as you are good at producing really strong fundamental trade ideas and timing them well. Now, because of the assumption of the market, because of human psychology, we understand that now, and we understand why we have soft targets and hard stop losses, but also why we analyze everything on a 1-to-3 payoff ratio. It's so we can basically protect our downside and unleash our upside on every trade. Now, a really good example of that was Eurodollar, and this principle that we introduced you to with that example is the principle of trying to find the free trade. And that only happens once you've got a position. And this principle of the free trade is extremely powerful, because when you're trading over 1 to 3 month time horizons and going for the percentage moves that we look to go for over those time windows, so having the 3% stop loss with the 9-10% soft target, when you're going for those size moves and they start to play out and start to break technical levels, you can start adding to positions in a way that ensures you can never lose money, because your risk management is strong and you're trading over a time horizon that allows you to do this, and your fundamental idea is starting to play out. And when you add to these positions, rolling your stop in a way that ensures you simply cannot lose money when you've added to the position, but now you're unleashing the upside in profit on the trade and capping the downside to ensure that you're still going to make money. This principle of the free trade is extremely powerful, and as part of an overall process, it's extremely powerful. Guys at the Institute have had incredible successes in their trading accounts by applying these risk management principles to fundamental trade ideas that have been timed well. And they come up quite often. They come up several times a year where you have a big winner in your portfolio because it's fundamentally right, you've timed it really well, and now you're adding to it and managing your risk really well on the principle of the free trade. Institute guys have been short Eurodollar, made a ton of money on that. That's one of the reasons why we use it as an example, because it was a classic example towards the end of 2014, beginning of 2015. Made a ton of money on the oil move down from $100 down to $50. They were shorting it all the way down and making sure that their risk management was perfect all the way down, and that the stop loss was always ahead of the average price, which ensured if they get stopped out, they would always make money. And they've done it continuously in a number of stocks when they're long and short in their overall long-short portfolios. And the principle applies to currencies. Of course it does. It applies to every asset class. The guys had great successes on Eurodollar, and this principle was applied all the way down. So the big things here: make sure you get the big picture right. The big picture is fundamental idea generation. The ideas come out of the idea generation process. Gatekeeping, timing, that's there to stop us doing stupid things. Risk management is there to stop us being human. And you've got to be a good risk manager as much as generating your ideas. Okay, so now let's move on to having discipline 2, risk management 2. We're going to look now at more parameters that we can deploy into our portfolios, so more risk management parameters that will make us better traders in terms of managing our risk over the longer term and being consistent in our approach. I'll see you in the next video.